Welcome back to Money Talks, your guide to the Canadian Securities Course. We're so grateful for your continued support. If you enjoyed this episode, please take a moment to subscribe, like, leave a comment, and share it with your friends. It truly helps us bring you more of this content. We're also working on a special project to make this podcast even better, and we'll be sharing some exciting news with you soon. Hey, Jonathan, a very warm welcome to the show. How's everything going?
It's great to be back, Rita. Things are going well, thanks. Always a pleasure to be on Money Talks.
We're thrilled to have you. Today, we're diving into a topic that's really the heart and soul of professional investing, the portfolio management process. For our listeners who are just starting their journey, could you talk about the importance of portfolio management? It sounds a bit intimidating.
Absolutely, and it's a great place to start, Rita. Think of it like building a custom-designed house, Rita. You wouldn't just start throwing bricks and wood together without a blueprint, would you?
Definitely not. I'd end up with a very lopsided shed.
Exactly. Portfolio management is that blueprint for your financial future. It's a structured, ongoing process that ensures all your investments, your stocks, bonds, and other assets work together harmoniously to achieve your specific life goals. It's not just about picking a few hot stocks, it's about building a solid, resilient structure.
So it's more than just the sum of its parts.
Precisely. The magic of the portfolio approach is that the whole becomes greater than the sum of its parts. The return of the portfolio is the weighted average of each security's return, but the overall risk is almost always less than the average risk of the individual securities. It's like having a team of superheroes. Each has their own strength, but together they can tackle much bigger challenges with less danger. This improved risk-reward trade-off is the core benefit.
That makes a lot of sense. So where does this blueprint process begin? What's the first step?
It all starts with the foundation. Step one is to determine investment objectives and constraints. Before we even think about what to buy, we need to understand the why and the what-ifs. We translate life goals like retiring at 60, buying a cottage on Lake Muskoka, or funding a child's education at McGill into tangible investment objectives.
And what are those common objectives?
They generally fall into three primary buckets: safety of principal, income, and growth of capital. Imagine a young couple saving for a down payment on their first home in Vancouver. Their primary objective is the safety of their principal. They can't afford to lose that nest egg. So they might lean towards very safe investments like Government of Canada T-bills or high-interest savings accounts, even if the return is modest.
Right, they're not looking to gamble with their future home.
Exactly. Now imagine a retired couple in Calgary. Their pension covers most of their bills, but they need a bit more to live comfortably and travel. Their main goal is income. They want a steady stream of cash flow, so their portfolio might be weighted towards dividend-paying stocks from stable Canadian companies like Royal Bank of Canada or Bell Canada, and corporate bonds. They'll accept a bit more risk than the first couple to generate that higher income.
And the third, growth?
That's for someone like a well-paid software engineer at Shopify in her early 30s. She has a long time horizon and a good salary. Her primary objective is growth of capital. She wants to build a substantial nest egg for an early retirement. She's willing to take on more risk for higher potential returns, so she might invest more heavily in growth-oriented stocks on the S&P TSX Composite Index, maybe even some tech startups.
Those examples really clarify the differences. You also mentioned constraints. What does that mean in this context?
Constraints are the boundaries or rules of the road for the portfolio. A huge one is time horizon. The 30-year-old engineer has a much longer time horizon than the retired couple, so she can weather more market ups and downs. Other constraints could be liquidity needs. Does the client need to be able to access cash quickly? Or tax considerations. A high-income earner might prefer investments that generate capital gains, which are taxed more favorably in Canada than interest income. Then there are unique circumstances, like a client who only wants to invest in socially responsible companies.
It sounds like a very personal, in-depth conversation you need to have with the client.
It's the most critical part of the entire process. It's like a doctor diagnosing a patient before prescribing medication. You have to understand the full picture. All of this information, the objectives and the constraints, is then formalized in what we call an investment policy statement, or IPS. That's step 2.
The IPS, so that's the official blueprint?
You got it. The IPS is the formal agreement between the advisor and the client. It sets out the rules of the game, the client's goals, their risk tolerance, and the guidelines for how the portfolio will be managed. It's the document we always refer back to, ensuring we stay on track. It prevents making emotional decisions when the market gets choppy.
Jonathan, that's a fantastic breakdown of the foundational steps. It really shows how personal and structured the process should be. Listeners, if you're finding this valuable, please hit that subscribe button and share this episode. It helps us keep bringing experts like Jonathan to you. You can listen to Money Talks on Spotify, Apple Podcasts, YouTube, Podbean, Audible, and many other platforms. All right, Jonathan, we've laid the foundation with objectives, constraints, and the investment policy statement. What's the next step in building our financial house?
Now we get to the architecture. Step 3 is to develop the asset mix. This is where we decide how to divide the portfolio among the main asset classes: cash, fixed income, and equities. People often say that this decision, the asset allocation, is the single most important factor determining a portfolio's overall return.
More important than picking the right individual stocks?
For most investors, absolutely. Getting the asset mix right for your goals and risk tolerance has a much bigger impact over the long run. Let's go back to our examples. The young couple saving for a house might have a mix like 10% cash for emergencies, 80% in short-term fixed income like GICs, and maybe only 10% in conservative equities. Their priority is capital preservation.
And the retired couple?
They might have something like 5% cash, 50% fixed income, a mix of government and corporate bonds for steady interest payments, and 45% in blue-chip, dividend-paying Canadian stocks for a combination of income and some long-term growth to fight inflation.
Okay, so the asset mix directly reflects the objectives we set in step 1.
Exactly. And this isn't a set it and forget it decision. We have to think about where we are in the economic and equity cycles. Generally, the stock market is a leading indicator for the economy. It tends to recover from a downturn before the broader economy does. So, if we believe the economy is heading into a recession, we might tactically reduce our equity exposure and increase our holdings in long-term government bonds, which tend to do well when interest rates fall.
That sounds like market timing, which I hear is very difficult to do.
It is incredibly difficult, and that's why we have different approaches. The long-term core asset mix is called the strategic asset allocation. This is our baseline, our 60% equities, 40% bond split, for example. Then there's tactical asset allocation, which allows for short-term deviations from that strategic mix to capitalize on specific opportunities. For instance, if we think the Canadian energy sector is undervalued and poised for a rebound, we might temporarily overweight our portfolio with stocks like Suncor or Canadian Natural Resources before returning to our strategic mix later.
So once we have that asset mix defined, then do we start picking the actual investments?
Yes, that's step 4, select the securities. This is the step everyone thinks of as investing. Based on our asset allocation, if we need to add a Canadian bank stock to the equity portion, we'll analyze the big players, RBC, TD, BMO, and decide which one best fits our criteria for value, growth, and dividend yield. If we need a corporate bond for the fixed income portion, we'll look at offerings from companies like Rogers or Enbridge and assess their credit quality and yield.
And the process doesn't stop there, right?
Not at all. Portfolio management is a continuous cycle. Step 5 is to monitor the client, the market, and the economy.
Life changes. The client might have a child, get a promotion, or decide to retire earlier. Those events change their objectives and constraints.
The markets and the economy are also constantly shifting. We have to monitor all these things to ensure the portfolio remains appropriate.
Which leads to evaluating how we're doing?
Precisely. Step 6 is evaluate portfolio performance. We need to measure our success. are we meeting the return objectives we set out in the IPS? We calculate the total return, which includes both income and capital gains, but just looking at the return isn't enough. We have to consider the risk taken to achieve it. A popular measure for this is the Sharpe ratio, which essentially tells you how much return you've generated for each unit of risk you took on. A higher Sharpe ratio is better.
So a portfolio that returned 8% with very low volatility might be better than one that returned 10% but was on a wild roller coaster ride.
You've nailed it. It's all about risk-adjusted returns. And finally, all of this monitoring and evaluation leads to step 7, rebalance the portfolio. Over time, because of market movements, your asset mix will drift away from its target. If stocks have a great year, your 60% equity allocation might grow to 70% of the portfolio. Rebalancing is the discipline of selling some of the winners, in this case stocks, and buying more of the underperforming asset class, perhaps bonds, to bring your portfolio back to its original strategic allocation.
That sounds a bit counterintuitive, selling what's doing well.
It does, but it's a disciplined way to manage risk. It forces you to sell high and buy low automatically, preventing your portfolio from becoming too concentrated in one area and taking on more risk than you intended.
Jonathan, this has been an incredibly clear and comprehensive walkthrough of the portfolio management process. You've taken what seems like a complex professional discipline and broken it down into a logical 7-step journey.
My pleasure, Rita. If listeners take one thing away, it should be that investing isn't about chasing hot tips. It's a disciplined, personal process. Having a roadmap, a portfolio management process, is the surest way to navigate the markets and reach your financial destination.
A perfect summary. Jonathan Cartier, thank you so much for sharing your expertise with us once again.
Anytime, Rita.
And a huge thank you to our listeners for tuning in to another episode of Money Talks. Don't forget to subscribe and leave us a review on your favorite podcast platform. We'll be back soon with more insights to help you on your Canadian securities journey.